The broadcast is now starting. All attendees are in listen-only mode.
Well, it's the 31st of July. Quite nice to actually do our webinar at the end of the month, just to make sure that you can see my beautiful wallpaper. There we go. You can see I do have a softer side, Stuart. No, it's a rented house, which is what most South Africans stay in when they live in the UK. And you can see these beautiful flowers. Anyway, just to let you know, I'm here in London today and being present and correct and no cardboard cupped out and able to bring you up to date on the global portfolio, the BizNews global portfolio, which continues to perform well above expectations. We'll get into that in a moment, though. But Stuart has, first of all, got the technicals.
Thanks, Alec. Just some housekeeping quickly. If you can please just raise your hands on your bar there, it's on the control panel, just if you can hear us clearly. I see a few hands coming through. That's excellent. That's good to see. And just, we do like to keep it conversational. There's a little questions panel on the control panel, a little drop-down menu. If you plot them in there, I'll pass them on to Alec. I've already got a couple there, Alec, but let's get started and then I'll sort of drop them in.
Yeah, we got a lot to get through today. It's been a quarterly results season in the United States, and most of the stocks in our portfolio have reported. So I'd like to give you some insights into those as well. But really, the important part of this, I guess, is just to have a look at the changes that have happened in the past month. You do remember, or maybe you don't, maybe you're joining us for the first time, so let me just outline it. The way we manage this portfolio is that the stocks that are purchased forever. So we intend never to sell any shares. Of course, we do sell shares because changes happen in companies and the fundamental philosophies of businesses are adjusted from time to time, which makes them no longer suitable for our portfolio. On the other hand, we might find something better to put into the portfolio than some of the existing stocks, and then we will make changes too. But in the 4 years that the portfolio has been going, we haven't made more than half a dozen adjustments or changes, selling out one stock, bringing in another one, and that has been part of the success of this portfolio, very aligned with what Warren Buffett would tell us, which is don't trade, find the right stocks and hold them forever. And as a result, you cut down your transaction costs, and also it makes you think very hard before you acquire a new stock into the portfolio. You will see here that in this past month, we bought 40 Adobe Systems shares. This is the second tranche of Adobe Systems that we have purchased. Apologies for my little bit of dyslexia there in systems, but the second tranche. And the interesting thing here is we bought the second tranche at just about the same price that we bought the first tranche. Yet, Adobe Systems share price actually rose very strongly after we bought the first tranche. Both of them now have been purchased in at $242 a share. First lot at $242.25, the second lot at $242.32. But as you can see on the graph there, this decided decline in the share price of Adobe Systems in the last day. So we've been very fortunate. If we had the webinar on Friday last week, we would have ended up paying more than $10 a share more than the $242.32 that we're buying for the second tranche. Just to explain how that works as well, when we decide on purchasing a new stock or bringing a new stock into the portfolio, we buy it over 3 months. So we will buy 1/3 in the first month, the second third in the second month, and the final third in obviously the third month. And the reason for doing that is that because we are rand-based investors, we have a double issue here, both the value of the rand on the one hand and the value of the stock itself. So we try to take out that risk or that vulnerability as much as possible. You might go and have a look at, to give you an indication of how big an impact this can have. I wrote a piece yesterday on the Hulamin financial results, and Hulamin, a company that buys all of its raw material, i.e. aluminium, at US dollar prices, but it is a rand-based company. Its costs are all in rands. The difference in the metal price difference that it did in the last 6 months, in the 6 months to the end of June, there was a swing of 125 million rand in its bottom line as a consequence of those differences. Of course, Hulamin is a price taker. They go in, they got to buy the aluminium at the day that they buy it, that it gets delivered to them. In our case, we try to remove as much as possible the impact of those share price movements by buying over 3 quarters. And we bought the second tranche now. As it happens, we got really lucky. The share price fell yesterday, and as I put in the headline, there's sometimes lower prices are good. They certainly have been good for us. We also dodged a FANG bullet. You might be aware that Facebook's financial results came out. We used to have Facebook in the portfolio. We also were quite keen on Netflix at one point in time. I just couldn't get the courage to buy Netflix. It just seemed too expensive. I'll be looking at it very closely now. I love the company and I love the business model, but it really was just a little expensive. Facebook we moved away from because of the issues that it was having with, well, Cambridge Analytica was the starting point of it. And as you can see, this portfolio has got none, or does not have Facebook and does not have Netflix in it. And as a consequence, our portfolio did pretty well. But I want to just dwell a little on Facebook because this is a stock that used to be in the portfolio. We got out of it after Cambridge Analytica. There were other people, however, who didn't get out of it after Cambridge Analytica and looked very good for a period of time. Facebook did flop really badly, and as you can see there, before the conference call, the share price, or by the time that this little bit of the conference call to shareholders was recorded or played, the share price dropped 16%. I want to play it to you because it is a very significant part of what happens in, or what can happen rather, to a stock in a portfolio, and it gives you an indication as well. Stuart, just to check, can you see the main screen now? Can you see this, Stuart?
Alex, sorry, that's perfect. We did lose you for a second there.
All right. Well, let's just have a look. Just have a listen to this, and you'll see what happened.
Our total revenue growth rates will continue to decelerate in the second half of 2018, and we expect our revenue growth rates to decline by high single-digit percentages from prior quarters sequentially in both Q3 and Q4. There are several factors contributing to that deceleration. For example, we expect currency to be a slight headwind in the second half versus the tailwinds we have experienced over the last several quarters. We plan to grow and promote certain engaging experiences like stories that currently have lower levels of monetization. And we are also giving people who use our services more choices around data privacy, which may have an impact on our revenue growth. European ad revenue growth decelerated more quickly than other regions and was impacted primarily by reduced currency tailwinds and, to a lesser extent, the rollout of GDPR.
Okay, I wanted to play that for you because it gives you a very good understanding of what is going on in the markets at the moment. It's fine if you have, Stu, just to make sure that we're back in the presentation. All yes, good? Is it all good?
Perfect,
okay.
Thanks, yeah.
Just to actually illustrate the reality of what's happening on the international markets. Now, Facebook, between the time, what happened in the conference call, and that, by the way, was from the Wall Street Journal, our partners at BizNews Premium. What happened was that Facebook had its conference call, the share price was flat. Mark Zuckerberg had his talk for a brief period of time, and then on came the financial director, and that little clip that you heard now cost the company $120 billion US. It's like you took the whole of Naspers and made it zero after a minute of conversation. Why? Why was it that big? Because when a company is getting the kind of stratospheric valuations that some of these businesses are, Facebook, Netflix, etc., you have to be pretty sure that the revenue growth is going to continue into the future. So if the growth is topping out, or if there's a concern, as the Facebook financial director said, a growth in the company's revenues are going to decline into the next few quarters, immediately it'll have an impact on the valuation. So just bear that in mind when you are investing in companies, and particularly the FANGs, as we call them. Right, let's move on to our actual portfolio.
Sorry, Alec, just on, there's a question
yeah.
on the back of Facebook from Benjamin Pretorius. He says, obviously, with the Facebook, what are your views on Tencent and then Naspers? Obviously, Tencent also had a bit of a smack this year, but he just wants to know if Naspers is a sell.
Right. Well, as you can see, it's an appropriate time to ask that, because good old Microsoft, which we love, has decided to go rogue on me at the moment. I'll pull it up again. I'll pull up the there we go, global portfolio. It's coming up in a second. I'm still a big fan of Naspers, a huge fan of Naspers, in fact, because it is at a massive discount to the underlying value. Stuart, sorry, before we get there, can I just confirm that everything's looking good again on the screen?
So no, Alec, we can hear you, but your screen has not been shared. So I'm not, if it's up on your side, it's just not coming through yet. There we go, perfect.
You got it. Okay, yep. Fantastic. Well, apologies for that little break in transmission. The sale by Naspers of 2 percentage points of its stock, its holding in Tencent, was very interesting. It was done at 405 Hong Kong dollars. Today, the Tencent share price is at 350 Hong Kong dollars. Now, it's not really such a big deal if you're holding Tencent, as we are in the portfolio, for a long time. But if you are selling a chunk of the shares, and Naspers actually sold, just to put it into context, they sold 190 million shares in Tencent. So had they sold those shares today, rather than a couple of months ago, as they did, the difference in the income from the sale of the shares to Naspers would be over 14 billion rands. 14 billion rand. So when you are looking at Naspers and you get all this controversy over executive remuneration, I really urge you just to see it in context. And also to see another thing in context, the decision that Bob van Dijk, and he is the chief executive, he would have motivated that decision to cash in a few of the chips there with Tencent, and the timing of the deal as well. What he's done is he's put together a war chest now almost indefinitely. Naspers can continue growing, can invest in everything that it's got for a long period of time. But what they've also done, one of the areas that they've invested in is food delivery, online food delivery. And they have now the hottest stock in Europe is called Delivery Hero, the hottest food delivery stock in Europe. And food delivery is becoming a huge market around the world, and investors are suddenly clicking to the opportunities that exist. Now, in the same way that Naspers was early to market with Tencent, was early to market with Mail.ru, it's been early to market with Flipkart in India, which has now been bought for a massive profit for Naspers, more than $2 billion by Walmart. It's been early to market in food delivery. So don't knock these guys. They really are world-class, and they have made some incredible investments. Also, they're trading at a 40% discount, or just to the Tencent shareholding, let alone Delivery Hero. And do I like them? I don't like them. I love them. I love Naspers. I love the stock. And I think that as South Africans, we are analyzing it a lot more closely than most people around the world. And as a consequence of that, other people in other parts of the world will eventually come to the conclusions that you have to come to if you're close to the business and you've seen the track record of this organization. I don't know where you're going to find another Koos Becker, but you certainly have got a very, very good guy in Bob van Dijk. And I hope that the South African investors who realize how much Naspers has done to the value of their portfolios. Remember, Naspers today is over 20% of the equity holdings of pretty much every South African. That's the share it is in the JSE All Share Index. So the surge in Naspers has actually had a direct impact on the wealth of South Africans. Every South African, pretty much, who's got a retirement annuity fund or in a pension fund. So yes, I love it, and I really think that they're a very smart global organization. I'm not talking about what's going on in South Africa or maybe the multi-choice who've got, well, they've done pretty well there. They've turned that around quite nicely. But I'm talking about the global organization, which is 80% of the portfolio, excluding Tencent. Take Tencent out of it. The business is 80% offshore. They really are great competitors everywhere, and they've made some amazing bets. So don't knock these guys. Just be thankful that you've got them in your portfolio. That's my view on it. Okay, let's look at our portfolio. There it is. We are up again this month, which is quite gratifying given the messy set of quarterly results that came out. As you can see there, of our main holdings, and we have 10 holdings in the portfolio. In this past quarter, 6 of them were up, 2 were down, and 1 was level pegging. That doesn't make 10, does it? It makes 9. We have 9 holdings in the portfolio. 10 of you add cash. The cash was down a little because we bought those Adobe shares. So that's the reality there. If you take it all in all, the rand appreciated from 13.68 rand in the a month ago to 13.17 rand today. You can see the depreciation. In other words, the loss that the rand experienced up until a month ago. We did the last portfolio on the 27th of June and actually went above, almost got to 14 rand to the US dollar after that. That was on fears about expropriation without compensation, justifiably. That is a really crazy policy. Just ask the Zimbabweans about it. And the consequence of that, though, was that after that settled down and there was some very good news that came into South Africa with the Chinese promising to bring in nearly 15 billion US dollars. Also news coming from the Middle East in July that both the UAE and Saudi Arabia will be investing $10 billion into South Africa. Ordinarily, that would have taken the rand to probably around, well, if there was no EWC, no expropriation of land without compensation, you'd probably see the rand now trading at 11, perhaps. But because if you go back, you take the EWC issue out, the rand was trading just above 12. It would probably get to 11.50 or certainly 11 on the good news that's come through. But that good news has been enough, though, to assist the rand, despite the EWC concerns, to trade where it is at the moment at 13.17 rand. This, by the way, is a graphic which is part of a treasure chest of graphics that you can get on BizNews. It's in the free to air section. You go to the BizNews homepage and then click on market data. You have got a discovery awaiting you there if you haven't seen it yet. I'm not going to take you through it again this month. I showed you last month. But this does give you a lot of information that you can play around with. We have the SENS data for every single JSE listed company going back to the year dot. Obviously, each JSE listed company does have its own page as well, and that gives you lots of detailed information. There's anything you need, and there's a daily ups and downs of what's happened to the share prices. So go and have a look at that if you haven't discovered it yet. You've got a treat in store. But that's the movement then in the rand, which of course in this portfolio, because it is US dollar primarily based, it does have a negative impact when the rand strengthens. But as you can see there, the portfolio in rands, in fact, went up in the last month, and that was because of those 6 improvements, or the improvements in 6 shares in the portfolio, and only 2 going backwards, Tencent and Alibaba. We'll talk about them later. And as a consequence, the value of this portfolio, which started at $200,000, is now $360,000, started almost 4 years ago. In rands, it was just over 2 million rand. It's now sitting at 4.9 million rands. The annualized return on the portfolio over this period has been 36%. And the reason for that is what you can see on the screen right now. Thank you, Amazon. Thank you, Jeff Bezos. as you can have a look there, we bought Amazon shares at $327 a share. They're now sitting just under 1,800. In fact, they got to over 1,850 in the past month before coming back to where they are now. Where we are today in Rand terms, the Rand has depreciated 17% in the last 4 years. Not bad. Amazon is up 534%. Also an amazing growth for us from Alphabet. Apple has done well, also beating the market. The market is shown by Vanguard, the S&P 500 index. Berkshire, very close to the S&P 500. And Tencent, Alibaba, and Microsoft were added to the portfolio more recently. So that is not a true reflection of their performance against the Vanguard S&P 500 index. There we go. More graphically, you can see how Amazon has been a winner. And that's really what I urge you to think about. Ride your winners. Stay with your winners. If there's one thing that this portfolio will tell you, or the performance of this portfolio will explain, it's don't get too clever. Don't think that once you've never made a profit until you sell. That isn't so. You know that you start paying tax when you sell. And also, to find a winner like an Amazon or an Alphabet or even an Apple is not easy. You do a lot of research, a lot of homework to find a stock that you can invest in for the long term. So why then trade out of it if it has appreciated to a level that some stockbrokers might say to you is a time to take your profits? My view is completely different. When you find your winners, you stay with them. When you, for instance, own Naspers shares and you've had a good run with them, don't be tempted by the daily noise of the news flow to cash in your chips. Rather, stick with a company until such time as those fundamentals, the underlying fundamentals, change. It should take you a long time to analyze a company before you invest in it. And that's really what we've been doing. But then you know how to actually stay with it or what it is that you've bought. And let's talk about those individuals. Stu, I wonder if you want to have a quick question or two, and we can then go into the individual constituents.
Thanks, Alec. Unfortunately, we don't have any questions. We're a bit muted at the moment, but yeah, please, if the people listening can send them through, I'll pull them through to you as soon as they come through, Alec.
Brilliant. Well, we do have a lot to go through. So let's start off with Amazon, our champion. Amazon's net income, it came with financial results, second quarter financial results, is now starting to hit a bit of a tipping point, as you can see here. And again, thanks to our partners, the Wall Street Journal, for these graphics. That goes back to more than almost 10 years of quarterly operating income. And Amazon is one of those businesses that really can turn on or turn off its profits. If it invests less into capital expenditure, if it bumps up the margins a little bit, if it grows less, the profits will rise in that period. And what Amazon tends to do after it's had a particularly good period of strong profits, as we're seeing now in the last 3 quarters, it will then usually start investing heavily into something new. Now, the last time this happened, which was just over a year or so ago, it acquired a company called Whole Foods. Whole Foods has now been integrated into Amazon. Particularly useful there is that they are going to be offering, or are offering, the Amazon Prime members special deals on Whole Foods. Whole Foods is a company started in Texas, which was way ahead of the game in organic and healthy foods. As you can imagine, when it first began in the United States, where things back then were not exactly health conscious, Whole Foods struggled. But just as it was hitting its straps, along came Amazon, made an offer that the owners couldn't refuse, and it's now part of Amazon. It's being plugged into the Amazon network, and in the past year, the turnovers at Whole Foods have shot up by 16%, which shows you that 1 + 1 can equal 3 if you've got the right basis for it. They've also rolled out Whole Foods in 20 cities in the United States. The intention, of course, is to roll it out throughout the whole world. But Amazon have done in 20 cities. And what they're noticing is that in those cities, the take-up has been far more aggressive than anticipated. In the earnings call, in the quarterly earnings call for Amazon in the past week, the financial director, Brian Ozavsky, said that this is one of the most rapid, one of the fastest rates of take-up for any Prime benefit. Now, there are more than 100 million people on Amazon Prime. And a member, as I'm a member of Amazon Prime here in the UK, it really is a fantastic system. You pay about £80 a year for it. You get free delivery, you get free videos, and it's excellent, the videos that they're offering you, free music. It's an irresistible offer if those are things that you consume, digital products that you consume. But it also translates into soon here in the UK, I'm sure Amazon will be coming in and offering Whole Foods type foods. Well, it already does offer groceries, but it'll be offering an expanded service, given that what this company does, and if you read Jeff Bezos's reports to shareholders, and that's a very, very good idea to do that if you're in business, just to understand how world's best businessman, because he really is, approaches things, how he's got this absolute obsession for providing great service to consumers and a better deal to consumers, and that's what he believes in. He believes that by doing that, his company will benefit, and boy, has it done so. In the last year, where they really have, or in the last quarter, where they really have been hitting their straps is in Amazon Web Services. Now, this is all part of the whole movement in computers, from having your own hard drive to putting things into the cloud. Amazon was 7 years ahead of the pack there. So they invested way, way before anybody else. Amazon Web Services is by far the biggest player in that field. They're getting competition now from Alphabet, the parent of Google, and from Microsoft. But Amazon Web Services, being so far ahead and being so highly competitive, the earnings, in other words, the profits coming out of that part of the business, jumped by 79% year on year to $1.6 billion US. So that is a big part of the business earning. And it's interesting that that side of the business earned as much money as the whole North American retail side, which is Amazon.com, the e-commerce side. But the Amazon.com side operated at a margin of 2.9%. So now think to yourself, you've got economies of scale, you've got this huge retail network, and you are generating your profits at a margin of 2.9%, which is what someone like ShopRite will generate, a similar kind of profit margin. But you don't have stores, you don't have all the other costs that ShopRite or a traditional retailer like Walmart has to put up with. So you can just see how this chain is leaving the station and how the momentum is gathering. Amazon is the best company in the world, in my opinion, and it's one that I wouldn't even dream of selling at the moment. Overall revenue at the group went up 39% in the last year. That fully justifies the kind of stratospheric ratings that you're seeing in this company. And it's still going into new areas. It's still discovering areas where its business model can be applied. It's what do they call it? A behemoth wouldn't be the correct description. It's just it's growing too rapidly. I love Amazon, and I think you should too. Stu?
Alec, just on Amazon, EJ says it looks like Amazon is entering the SA market. How do you think it'll impact Naspers and things like Takealot?
Yeah, that's an interesting question. It has taken a while to gain traction in emerging markets. If Amazon were to, well, Amazon is big in South Africa. Let's just start there. Amazon has got huge data centers in South Africa, which serve the rest of Africa. If you do your homework and you walk around Cape Town and start asking people in Cape Town, you'll find very quickly that there are thousands of Amazon employees sitting in Cape Town already. So Amazon Web Services is there. What I think you're referring to is Amazon's retail services, and that would be a call, I guess, that they're going to they would make on the basis of whether or not they thought the South African economy was one that would be growing in future. I can just share with you an experience I had in 2012. I had just left MoneyWeb and had this idea that, given the experience that I had in digital publishing, that if we brought the Huffington Post to South Africa by applying what I'd learned over the years and the team that obviously the people in the team I wanted with me, that we could apply, we could probably make a success of a partnership with a big brand like that. And I went to New York and I went and met with the people at HuffPost. I'd spoken to Ariana Huffington on various occasions in Davos, but she wasn't there, but I did meet in her office with members of her team. And we had quite intensive discussions at that time. The consequence of it, though, was that we were so far down the pecking order on their international expansion that they said to me, look, we'll come back to you at some point in time, but they decided not to go ahead with it. We were just too small. I know that Naspers is a whole lot bigger than AB Hogg Esquire. So Naspers was able to convince Huffington Post to come to South Africa. But that, I'm sure we now know, was a Naspers decision, not a Huffington Post decision. And as a consequence of that, you know that Huffington Post has closed down in South Africa. So they came, they spent a little time there and then closed down. But Amazon moving into the South African market would be very similar, I'm sure, to the view that AOL, which owned Huffington Post at the time, would have taken. Is that where in the world are things growing fastly? And where in the world can we get the best return on our effort and our investment? And if they see South Africa as an opportunity, then it's a good thing for the economy. But at the moment, they're investing a lot of the resources, obviously, in the North American market and in Western Europe, but also in India, where Amazon is now going head-to-head with Flipkart, which is owned by Walmart. So will it come into South Africa in the retail space? Maybe. If it were to do so, how far on the pecking order is it? Not too high up to give Naspers too many problems, I think, at the moment. But who knows? I hope it's a long answer to a short question, but I hope that gives you a little bit of color and insight.
Thanks, Alec. Just a follow-up from Eddie. Wants to know, do you think Amazon will face regulation in the future? It seems to be a big topic of the day.
Well, it certainly has got up Donald Trump's nose, but it's very different. Amazon's exposure is very different to, say, an Alphabet or a Facebook, where the kind of regulation that could be introduced there on both Amazon and Facebook would be privacy, etc. On Alphabet and Facebook. On Amazon, in Amazon's case, it's a little bit like a ShopRite. You could find that the South African government wanting to implement BEE regulations, it can squeeze companies like the banks, because the banks do a lot of business with government. It can squeeze construction companies who build a lot of stuff for government. But it battles to squeeze a retailer, because a retailer sells to many people. It doesn't sell to government. So if they were to go along to ShopRite and say to ShopRite, we demand that you have 26% of your shares owned by BEE people, and by the way, here's the list of all our cronies that you can give it to, ShopRite would probably say, thanks, but no thanks. And there's not a hell of a lot that the government can do to ShopRite. They can't bring in a new tax on retailers, for instance, because that would hit all retailers. So that's really the situation that you're talking about with Amazon. Because they have got literally billions of customers, it's very difficult for a government or for politicians to regulate them in some way. Whereas it's much easier if you're talking about more or less substantive things than selling products, as Facebook and Google are the position they're in. Politicians, though, can play all kinds of games. There's a lot of hypocrisy there. I'll give you an example. In the UK, newspapers, if you buy a newspaper, you don't pay VAT. But if you buy, so your subscription to the Financial Times, no VAT. A subscription to the online section of the Financial Times, you pay 20% VAT. So it just gives you a feeling that there's politicians are able to, well, I think they're the worst of the hypocrites in the world. So who knows? Trump will probably try and do something to Amazon. But from everything I've seen, and from you look at their business model, they are pretty invulnerable to those kind of impacts. And of course, you've always got the Constitution to rely on. So as much as the politicians might be on a revenge, and I can tell you, Donald Trump hates Amazon. If there was anything that he could have applied, he would have done so. And the reason he hates Amazon is because he hates the Washington Post. And the Washington Post is continuously carping on about or highlighting Donald Trump's failings. And the Washington Post is owned by Jeff Bezos, who's the founder and the biggest shareholder in Amazon. So that's the story. So if he would have found something to hit Amazon with, he probably would have hit them already.
Thanks, Alec.
So have a look at that. The Amazon share price is a giant. It didn't react that positively to the financial results this quarter. As you can, if you go back to 2017, you can see the huge surge in the share price there from around 1,000 or below 1,000 to above 1,000. Very decisive break there. It did, in fact, go up a little bit, but in a messy quarter, you could be quite happy if you're Amazon shareholders that the share price did not collapse as some of the others did. And that's primarily because the financial results were very strong. So were they at Alphabet. Have a look at the net revenue numbers here. As you can see in the second quarter, they were up very strongly year on year. Amazon's revenues, as mentioned earlier, are growing at 39% a year. Alphabet's are growing at, well, almost as much. The revenues there are 25% in the past year, and it continues to surprise on the upside. In the past couple of weeks, in fact, earlier in the month, we had the EU levying a $5 billion fine on Alphabet. Alphabet said it will appeal, but just in case, it's going to knock it off its profits. So it's taken the hit of $5 billion on its profits already. And even after taking that hit, the profits were only down by 9% for the second quarter. That is the number without the fine. And you can't really bring the fine. Well, their appeal might be successful. Who knows? They'll certainly drag it out. The lawyers will drag it out for a long time because it's a big fine, $5 billion. But without the fine, the earnings that were delivered by Alphabet in the quarter were $11.75 a share. The analysts had predicted without the fine, it would be $9.60. So they shot the lights out as far as profits are concerned, primarily coming from online advertising. Alphabet has 31% of global digital advertising, or the global digital advertising market, and it is moving aggressively to entrenching its position. Capital expenditure in the quarter doubled to $5.5 billion. And the R&D went up sharply as well. This is a company that now has 89,000 employees, and it gets the cream of the crop. And in the past quarter, it was up by 4,000. So its staff numbers are up 4,000. It's adding brain power all the time and using that brain power and capital expenditure in areas that it's identified where opportunities exist to expand and get bigger and bigger. And that's really what it's about, the guerrilla game. If you understand technology companies, the big technology companies are the ones that usually get bigger because they attract the best talent and they have the revenues and resources to reinvest in particular areas, as they're doing here at Alphabet. The problem, of course, will be if they start making the wrong kind of bets, or if they bet too much in a particular area, or if you get regulation like is going on in the EU. By the way, that EU regulation was to do with Android, the Android system, which is available on 80% of smartphones around the world, which again gives you an indication of the dominance of Alphabet. You can see there after the quarterly results, share price went up, came back a little bit as the whole of Wall Street has done in the last couple of days. Let's move on to our next stock in the portfolio. Stu, just from your side, have you got any insights, or is there anything, any more?
I've got nothing on Alphabet. It's just, I know we picked up on it last time. Wants to know, Dion Martin wants to know why we've dropped Metro Bank. He didn't really know why. Obviously, he missed the last portfolio discussion.
Yes. The reason for dropping Metro Bank was scandal. A scandal hit the company about 6 weeks ago when it was disclosed that the chairman, the guy that I met, who you might remember, and one of the reasons why I was so keen on the bank, the chairman had been giving contracts to his wife. And it was the same thing that happened to the company in the United States, the bank that he built in the United States. So it was a problem that we saw that might, a scandal that we saw that might actually continue to bedevil the company into the future. And that was the unfortunate reversal there. We'd also seen that things have turned against challenger banks in the United Kingdom. There was very favorable legislation for them. That is now reversed and turned the other way. And that was another thing that was weighing on the company. And the third thing about Metro Bank that was concerning us was that there is a boxing match going on between investors and the bank, the company itself. The bank is growing rapidly. It needs more capital, and investors in the UK are not stumping it up because they are taking the view that it will have to go back to the market and issue more shares. So they don't want to pay more for the shares that Metro Bank will have to issue. They would rather wait until it needs more capital, then it'll pay. They can buy more shares more cheaply, those who still believe in it. But primarily the big thing for us there was a feeling that scandal had hit the company, and we don't like to be invested in companies where there is scandal.
Thanks, Alec. An interesting question from Julian. He says, had you not sold Facebook, Metro, and Tesla and not replaced them, what would the portfolio be worth versus today? I'm not sure that's very easy to work out, though.
Yeah, if we go into Tesla, we sold it much higher than the current share price, so that's a tick. Had we Facebook, we sold it immediately after the scandal. Our timing on that one wasn't great. The share price is still a little higher than where we sold, so that would have been a negative. And then Metro Bank, it's very much where it was. We sold out of Metro Bank at, I'll just go look through my old notes a little bit. I think it was at $31.92, and the share price today, sorry, £31.92, and the share price today is £32.05 or something. So it's much of a muchness. If you go back into some of the other transactions that we've done over the past, though, it has worked out for us. We sold Barclays Bank, significantly higher than the current share price. We sold out of Novo Nordisk as well at significantly higher than the current share price. But I suppose the important thing is, what did you do with the money? Where did you reinvest the money? And in that respect, we've been very fortunate because the stocks we reinvested in have done a lot better.
Thanks.
Now,
you're going to move forward, or must I throw some questions?
Well, I don't know what's happening here, but I seem to be, now I don't know if I can blame Apple or blame Microsoft, but my PowerPoint has frozen on Alphabet. So okay. It looks like we need to just take some questions for the rest of the webinar.
That's perfect, Alec. Just from Len, he wants to know, do you think Facebook will rise in value again, future prospects?
Len, if you stop and look at what was said by the financial director of Facebook, which caused that decline, it is consistent with what we are seeing just walking down the streets. Now, if you pick up the Financial Times of London, the Economist publications that I read fastidiously, if you walk around in the UK and look at bus shelters, at billboards, you will see Facebook advertising aggressively. You never saw Facebook advertising in the past. What they're saying is that we're attacking fake news. So all of a sudden, Facebook has got a whole new item on its expense line, and that is advertising. It, up until this point, had massive margins, and those margins are now being compressed by a big investment that it is making in trying to change its image. Its image has taken an awful pounding after the Cambridge Analytica story. That's the first thing. The second thing is Cambridge Analytica itself highlighted an issue that some very smart analysts of these kind of things have been telling us about, and that is that Facebook and Google and others, but primarily those two, because they dominate, they own more than 60% of the online advertising market globally. Those two companies have been using our data, so the user data, and then they've been applying that user data, giving that to advertisers so they can advertise in it. Now, if you're in the media industry, you will know that you've got to get smarter. And that's one of the reasons we have Adobe in the portfolio, because the rest of the media industry initially try to downplay Alphabet and Google and say, well, you know, they aren't that much better than us, but they are. They really are. And then the rest of the media industry also has finally realized that if you can't beat them, you better find something that is more granular, if you like, than what they're offering to advertisers. And that is available through Adobe, which has moved aggressively into that market. So you can get tools from Adobe, which will give you greater information on people. Apple does a lot of this, but it maintains, Tim Cook has often said, we have got much higher standards of protecting privacy of our users than Alphabet and in particular Facebook. So he's had a few side swipes at them. So what you have then on Facebook's case, you've had everything going for it. They've been able to use privacy data any way they wanted to. They haven't been in a position where they've had to advertise at all, and their competitors have been on the back foot. A plus point for Facebook is that it also owns Instagram, but then again, and WhatsApp and Instagram and Facebook, but there again they're starting to get competition as well. So if you look into the future, you have to say that the perfection or the best time that Facebook had is the time it's now behind us. Into the future, those wins are going to be headwinds rather than wins from behind. And I would be cautious, and Facebook themselves have told us that their profit margins are going to come under pressure. So I'd be pretty cautious about projecting when I look into the future on that company, projecting a continuation of the past into the future, given those fundamental changes that are now imposing themselves.
Thanks, Alec. Paul wants to know, if you had any extra cash on hand right now, which of the stocks would you be buying or add into?
You're probably going to think this is crazy, Paul, but I would certainly be just replicating the portfolio as we have it. In other words, going big for Amazon and Apple I like as well. Google also, they've got these issues, but Google is just a powerhouse. Tencent has come back on reasons that have got a lot to do with the trade war and Donald Trump. So the value bet, if you like, would be Tencent and Alibaba. Berkshire Hathaway, which is also part of the portfolio, has given Warren Buffett the go-ahead to start buying back stock. That was very relevant. Berkshire Hathaway's share price went up by the most in something like 5 years, in 7 years. It's at its best day in 7 years. It went up 5% in a day, and that was because the announcement that up until this point in time, Buffett and Munger were restricted from buying back shares. Now, remember, Berkshire's sitting on $100 billion in cash. Probably 80 billion of that had been prepared to invest somewhere. It had been restricted from buying back shares by its own rules, which said that it couldn't buy at a price of more than 20% of the book value. Now, the book value for a company that's 50 years old of a lot of the assets is a lot lower than the market value today. So you can imagine the frustration. This was something, incidentally, that Buffett himself imposed. He imposed it, first of all, in 2011 by saying he couldn't buy back shares unless they were within 110% of the book value. Now, then it went up to 120% of the book value, and now it's just gone to a point that below intrinsic value. So intrinsic value is far north of book value at Berkshire Hathaway, as you would imagine for a company that's made some big acquisitions over many years. And Buffett's got a lot of money to spend. So that's one other stock that you could probably say buying Berkshire today, if you were being very defensive, your money would be comfortably invested there. Microsoft is doing extremely well as well. The Microsoft's starting to make good expansion in the cloud. There it's taking on Amazon and Alphabet, and that was something we got to quite early as well. If you recall, cloud computing up until 5 years ago was something that only Jeff Bezos was thinking about, and that is the ability to move data or the stuff you used to keep on a hard drive, move that into the cloud and be comfortable that it's going to be safe there. Microsoft rather, in its latest set of financial results, showed that it's making really good progress there, and its cloud computing is now about a third of the total revenues, and it's generating operating margins there of 41%. So that's something else. I just love the portfolio as it's structured at the moment, and I would say if there is a way that you could, if you got spare cash, just spread it between the stocks that you have in the portfolio. That's the reason why we put it together that we do.
Thanks, Alec. A question from Brett. He wants to know what percentage of your overall portfolio, so not just on the global one, would you have offshore as a South African?
Wow, that's an interesting question. If you are to step away from it and living in a country like South Africa, which has the tyranny of geography against it, often very isolated and with a history of isolation, we think differently in South Africa because there's exchange control, and we look within the country itself as a place that we're going to retire. But if you are to look at the world as a whole, South Africa's share of global GDP is less than 0.5%. Its share of the stock market is less than 0.25%. America's got more than 50% of the international, all the shares listed all over the world that are investable, that you can put your money into. Over 50% of the by value is in the United States. So if you're now saying, well, I'm going to restrict myself to the 0.25% that is in South Africa, you really are restricting your opportunities. But how much would you keep outside? Would you invest outside? I suppose you've also got to have a look at, if you're part of the world, if you're living in a town that isn't growing very rapidly, a town that needs to do lots of reinvestment and lots of equalization of its population groups, and lots of fixing up of messes that you made in the past, would you put your money into that town, or would you put your money into a town that is flourishing, that has addressed its issues, that is looking ahead in its economic policies? You know, when you look at South Africa's economic policies at the moment, they don't instill me with a lot of confidence. There's an enormous amount of socialism in the system. There's a reluctance to unleash the potential of human beings. which you see in other parts of the world, China is a good example, is first and foremost in the minds of those who are leading the place. So would I be even investing in South Africa? I don't know. I think you need to, as an investor, not look at things from a patriotic perspective, but look at things from a perspective of where is my money going to work the hardest for me. Now, in a South African context, there is exchange control. So although it's at a level now where it doesn't really impact most individuals, the super rich people, of course it does. But for most individuals, you can take out as much money as you want. The only question mark you would have about investing in the big wide world would be how much of the big wide world do I know compared with how much do I know about South African stocks. So put that into context. Where you invest in a share, you need to do your homework. You need to understand the business model. You need to invest in that stock forever. If the stock market's closed down for the next 5 years, just know that you're in a company that you're very confident is going to be able to continue growing. If you feel that you've got a good handle on international stocks, or as good a handle on international stocks as you do have on South African stocks that you prefer to buy into, then there's no reason why you should let the geography of the companies have any impact on you. I hope that answers the question.
Thanks, Alec. I think there's one here from Carl, a bit different. The media fight for Sky, is there an opportunity? I'm not sure what's happening in the UK around that, but that's, just whatever this.
Well, the fight is between Disney, Comcast, and of course Rupert Murdoch and so on. That's not investing, that's trading, that's opportunistic. There's nothing wrong with being opportunistic in buying or making investments, but be sure that if the stock market closed for 5 years, the opportunity that you're taking advantage of is going to fulfill or still be relevant in 5 years' time. I'm very cautious of trying to go into a gunfight with a knife. And in many cases, when you're talking about these issues, that's exactly what you're doing. In fact, you're going in with your hands tied behind your back when you compare the arbitrageurs and the traders who've got huge bank balance sheets behind them, banks or rafts of analysts who are checking out the minutiae of differences between this arbitrage opportunity and that one. To me, it's interesting to watch, but stay away. To me, an investment opportunity is something that a company that you know, that you understand, that you can see a long-term road ahead of it. Adobe being an example there. That's why we've added it to the portfolio, where you can see that you understand the opportunities that lie ahead of it. You watch its financial results. You make sure that the financial results that it's delivering, and Adobe is a good example there. Its revenues were up 24% in the past quarter, and year-on-year revenues. It's buying back $600 million of its own shares. It's got a program to buy back $8 billion of its own shares. It's a much smaller company with its revenues of $2.2 billion than most of those in the portfolio. And it's got subscription income of the 2.2 billion of 1.9 billion. So it's successfully transformed its model from one where you would go in and buy your Photoshop one-off or your other Adobe product to now where you're paying for it on a subscription model. You're buying it every month. I can get that. I can get what Adobe are doing in supporting media companies which have to buy its products to attack or to defend themselves against Google and Facebook. So I get that. Whereas Sky is a satellite television company. We're seeing people cutting the cord. I know here, for instance, if you can buy the package of all the sports products of Sky as a bundle, or you can buy individually if you enjoy football for $5 or $6 a month. That's all £6 a month. Rather than paying £80 a month, you pay £6 a month and you can get exactly what you want. Now, I don't know how that affects Sky's bottom line, but it doesn't seem to me, if they were selling something for, say, 40 in the past, and now they're only selling it for 6, that it's going to add a whole lot of value. So there's all kinds of complexities there that is Disney overpaying? Is Comcast going to be taking the Sky part? Is Sky overvalued, undervalued? These are very difficult questions. But when I look at something like Adobe and I can understand where their business model is and they're focused, when I look at something like Amazon and I understand where they are, when I consider Apple, whose results, by the way, are coming out tonight, and I kind of get where they are, then it just makes a lot more sense to stick with what you know.
Thanks, Alec. I think we've used up an hour. I know we've had a few technical problems, but I think it was good discussion.
Yes, my apologies for the presentation. It's the first time it's happened that it's frozen, but at least it didn't freeze right at the beginning. So you did have the opportunity to have a look at the portfolio. It's generating now an annualized return of 36%. We will have this video up on the site for BizNews Premium. And I would urge you to also join us on Friday. We've got a very special webinar on Friday, open to all. It's the 5th anniversary of BizNews. We turn 5 years old on Saturday, on the 4th of August. So Friday morning, around 10 o'clock, we are going to have the story of BizNews. And I think you'll find it quite fun. Join us for our birthday. Unfortunately, we can't really give away any presents and give you a little slice of birthday cake, but we can have a bit of fun. Hey, Stu?
No, definitely, Alec. I'm just on that. We'll have the registration link for that in tomorrow morning's Daily Insiders. So I just don't have it on me offhand now, but we'll get it ready for the newsletter tomorrow, Alec. So all listeners can plug in when they want to.
Yeah, and it'll be fun. We'll tell you where we come from, why we're here, what we're doing, and maybe explain a little bit about the BizNews story and why we love what we do so much and we love serving so much, because that really is at the end of the day what it's all about. So thank you for being with us again today and look forward to being with you on Friday.
Thanks a lot, Alec.